You know that feeling, right? When the economic news starts getting grim and everyone's asking, okay, where do I put my money? How do I keep it safe?
Yeah, it's a classic investor reaction to uncertainty. That fear kicks in and the hunt begins for, well, for a safe haven in the market.
Exactly. And people start looking at those sectors that seem, less tied to the big economic roller coaster, the companies that make stuff we all have to buy.
The everyday essentials, the critical medical care, things you can't just cut out when times get tough.
But here's the real question. Do they actually work as safe havens? Do these so-called defensive stocks, like consumer staples and healthcare, truly protect you when a recession hits?
That's the million-dollar question, isn't it? It shapes so much investment strategy when things feel shaky. The instinct is always to shore up the defenses in your portfolio.
And for years, consumer staples and healthcare have been the go-to answers for that resilience. Their whole business model seems built for stability.
Right, because they provide things people generally need, whether the economy is flying high or hitting a rough patch. Demand tends to hold up.
So that's exactly what we're going to do in this deep dive. We're going to really scrutinize the U.S. consumer staples and healthcare sectors.
Using the research you've provided, yeah. Let's see why they have this defensive reputation.
We'll dig into the history, their performance during downturn, what they look like now. Basically, do they live up to the hype when recession fears are real?
Okay, let's get into it.
Right. So before we jump into staples and healthcare specifically, maybe we should quickly level set on what we mean by recession. What does it actually involve?
Good idea. So technically, you often hear about 2 straight quarters of negative GDP growth. That's the common benchmark.
But it's more than just a number, right? It has real-world consequences.
Absolutely. That's what really matters to people. When the economy shrinks like that for a while, you usually see this cascade effect. People get nervous about jobs, maybe their income drops, so they cut back on spending.
And businesses feel that pinch.
Exactly. So businesses react, they cut production, they hold off on big plans, and crucially, they slow down or stop hiring. Sometimes they have layoffs.
Which then leads to even less spending. It's that downward spiral.
It can be, yeah. Less spending, fewer jobs, lower profits, less investment. It feeds on itself.
And for investors, this whole situation is, well, it's challenging.
It really is, because when companies are making less money, their stock prices often take a hit. You see more volatility, markets going down across the board, especially in industries that rely on people spending extra cash or businesses investing heavily.
It feels like everything's going down.
It can definitely feel that way. The tide goes out and a lot of boats get stuck in the mud, so to speak.
Okay, so that's the scary backdrop. And this is where the idea of defensive stocks comes into play, right? As a potential shelter.
Precisely. Defensive stocks, or sometimes people call them non-cyclical stocks, the idea is that their performance isn't quite so tightly linked to those big economic cycles.
Less sensitive to the booms and busts.
Yeah. While many stocks might mirror GDP pretty closely, these defensive ones tend to have a smoother ride, particularly when the economy is struggling.
And the basic reason for that is?
It really just comes down to necessity. They provide things people genuinely need day in, day out. Think utilities, you need power, right?
Right.
Basic food items, household cleaning stuff, personal hygiene products, and of course, healthcare. You don't just stop needing those because the economy's weak.
Makes total sense. You might delay buying a new TV or skip a vacation.
Definitely.
But you're probably still buying toilet paper and, getting your prescriptions filled.
Exactly. Now contrast that with cyclical stocks. Think car manufacturers, airlines, fancy retailers, maybe big industrial companies.
Things that do well when people feel confident and have money to spend.
Right. Their fortunes are really tied to the economic cycle. When times are good, people buy cars, travel, splurge a bit. When recession hits, those are often the first things to get cut from the budget, so those sectors are way more vulnerable.
So when investors are looking at a potential downturn, defensive stocks aren't really about hitting home runs. It's more about, playing defense, damage control.
That's a great way to put it. It's about stability and damage control. Their strategic role is protection during uncertainty.
So investors might shift some money into these sectors?
Yeah, some investors rotate part of their portfolio. The aim isn't necessarily huge gains. It's more about cushioning the blow, reducing the overall volatility of your portfolio when other parts might be falling sharply.
Kind of like shock absorbers.
Exactly. They can act as a relative safe haven compared to riskier, more growth-focused stocks. It's a core part of building a more resilient portfolio.
So they add stability and having exposure to these kinds of industries is just good diversification practice anyway, isn't it?
Absolutely fundamental. Diversification across different types of industries, different asset classes. It's all about managing risk. Including defensive sectors is a classic way to build in some stability, especially when you're worried about the economy.
But crucially, not recession-proof. No guarantees.
No, definitely not. Nothing is truly recession-proof. It's about being more resilient, not immune.
Okay, good clarification. Let's dig into the first big defensive sector then, consumer staples. What exactly fits under this label?
Okay, consumer staples. Basically, companies making and selling the goods people use, well, constantly. Things you need for everyday living. Food, drinks, household stuff like soap and paper towels, personal care items like shampoo and toothpaste. And interestingly, it also usually includes alcohol and tobacco.
Ah, right. Things people tend to keep buying. The stuff that's always on the shopping list.
Yeah.
Pretty much no matter what.
That's the core idea, and it's a huge sector. The sources mention a market cap around, $3.3 trillion, making up maybe 5.5% of the S&P 500.
Wow, okay. So significant, and it's broken down further, right? Like retailers versus manufacturers.
Yeah, you've got industries like food and staples, retailing, think supermarkets, warehouse clubs, then household and personal products, the P&Gs of the world, and food, beverage, and tobacco companies, the Cokes, the Pepsis, etc.
Got it. So what are the specific traits that give these companies their defensive shield during downturns?
Number one is just the essential nature of the products. We keep coming back to it, but it's key. Demand is just incredibly steady.
Relatively constant.
Yeah. Economic conditions might change how people shop, maybe more store brands, fewer impulse buys, but the overall need remains. You're still buying food, still cleaning your house.
This leads to that economic concept.
Yeah.
Low price elasticity.
Exactly. It means that even if prices go up a bit, the quantity people buy doesn't drop dramatically because they need the stuff. This steady demand translates into much more stable revenue for these companies compared to, say, a fashion retailer.
Right. So a company selling washing machines might see sales tank in a recession, but a company selling laundry detergent probably less affected.
Much less affected. Maybe people switch to a cheaper brand, but they're still buying detergent. That steady demand also often comes with pretty strong brand loyalty.
People get used to their brands.
They do. Think about coffee or soda or specific snacks. Even when money's tight, people often stick with the brands they know and trust, though price definitely becomes a bigger factor.
Okay, that demand stability makes intuitive sense.
Yeah.
How does it actually look in terms of stock market performance, especially during recessions?
Well, over the very long haul, the sector tends to track the broader market, maybe with slightly less growth overall. One source gave a 10-year return example ending April 2021. Staples were around 8.2% annually versus nearly 12% for the S&P 500.
So maybe not leading the charge in a bull market.
Generally not. They participate, but often lag the high flyers. But as you said, the real test is when things go south.
That's why we're talking about them.
Exactly. And this is where the historical data gets interesting. The sources clearly state that consumer staples outperformed the S&P 500 during the last 3 actual recessions, periods of negative GDP growth.
So it's not just theory, it's backed by recent history.
Right. And think about what that means for your portfolio. If the overall market is down 20%, maybe your staple stocks are only down 5% or even flat. That provides a real cushion.
That's significant protection.
There's another really striking piece of data, the correlation between consumer staples stock prices and the U.S. unemployment rate.
Let me guess, pretty low.
Almost zero correlation, according to the sources. Think back to the massive spike in unemployment in 2020. Millions lost jobs, cyclical stocks cratered.
But people still needed groceries.
Exactly. The consumer staples sector's price held up remarkably well. That lack of sensitivity to a huge economic shock like mass unemployment really underscores their defensive nature. It shows the fundamental need trumps the broader economic pain.
Wow, that low correlation really drives the point home. Okay, so demand is stable, performance holds up relatively well in downturns. What about the business environment within the sector? Is it easy sailing for these companies?
Not necessarily, even with steady demand. It's a tough business in many ways. It's a very mature market, meaning it's not growing rapidly overall, and it's highly saturated.
Lots of competition.
Intense competition, especially on price. Retailers are constantly battling each other with discounts and promotions. Manufacturers are fighting for shelf space.
So keeping profits high must be a challenge.
It is. Companies have to focus heavily on either building incredibly strong brands that people will pay a bit more for, or becoming hyper-efficient in their operations to keep costs down. You need differentiation or serious cost control.
So raising prices is hard.
Very hard across the board because of that competition. And it's tough for new companies to break in. Think about the established players, Walmart, P&G, Coca-Cola. They have huge scale distribution networks, massive advertising budgets.
High barriers to entry.
Very high. But even the giants face risks. People might trade down to store brands in a recession, and consumer tastes change. Think about the move towards healthier options or more sustainable products. That can disrupt the status quo.
But are there still ways for these big companies to grow, even in mature markets like the U.S.?
Oh, definitely. A major avenue is international expansion, especially into emerging markets. As incomes rise in other parts of the world, demand for packaged goods, brand name beverages, personal care products, that often takes off.
Okay, that makes sense. Let's shift to the financials. Do the numbers really back up this stability story? How do sales and earnings look?
Yeah, the financial data seems to align pretty well. The sources mention that in Q1 2024, consumer staples ranked what? Third for sales per share and fourth for sales contribution across the S&P 500.
Pretty solid top-line performance.
Right. And maybe even more telling, they had the lowest percentage of companies missing their sales forecasts in that quarter. It speaks to predictability, they know their market, and demand is consistent.
Okay, sales are steady and predictable. What about profits? Earnings per share, EPS.
Historically, EPS in this sector is described as extremely stable compared to others. You look at the overall S&P 500 earnings, you see these big dips during recessions, like that sharp drop in early 2020.
Right.
Consumer staples EPS, much flatter. It didn't collapse. That inelastic demand helps insulate their bottom line from those dramatic swings you see elsewhere.
And that earnings stability is really attractive for certain investors, right? Especially those looking for dividends.
Absolutely. Stable earnings support stable dividends. Many staples companies are known as reliable dividend payers, often increasing them year after year. That's another big part of their defensive appeal.
Okay, stable history, but what about the future outlook for earnings?
That's where things get a bit trickier right now. The sources highlighted a potential challenge. The forecast for EPS growth in consumer staples for 2024-2025 is actually pretty slow, even slightly negative, around -1.1%.
Minus 1.1%. Wow. How does that compare to other sectors?
It ranks them second lowest in the S&P 500 for projected EPS growth. So while the past has been stable, the outlook for actual growth is quite muted at the moment.
Stable, but maybe stagnant. And you mentioned margins being squeezed earlier.
Yes, and that's directly related. That intense price competition really shows up in the operating margins. They've consistently lagged the S&P 500 average for the last decade.
And currently.
In Q1 2024, they were second to last among sectors and operating margins. And the prediction is they'll likely stay low because of that constant price pressure, especially from the big retailers. It's just tough to make high margins on everyday essentials.
Okay, so steady sales, but tough to convert them into high profits, and slow growth expected. What other big-picture economic factors influence this sector?
Well, several things. While we saw stock prices weren't tightly correlated with unemployment spikes, very high, prolonged unemployment can eventually impact spending, even on essentials. Interest rates play a role. Lower rates might help consumer spending power a bit. Higher rates could hurt.
Energy prices must be a big one, too.
Huge. These companies use a lot of energy for manufacturing, transportation, running stores. Higher energy costs squeeze those already thin margins. And supply chain disruptions, we all learned about those recently. Things like natural disasters, conflicts, pandemics can cause big problems.
And what about inflation? Food prices went crazy for a while there.
Right. The sources noted that food inflation has cooled off recently down to about 2.2% year over year as of April 2024. That's much lower than before. Good for consumers, but it means less pricing power for the companies, potentially adding to margin pressure.
So putting it all together, the stability, the resilience, but also the margin pressure, the slow growth forecast.
Yeah.
How does the sector look from a valuation standpoint today? Is it cheap, expensive?
It's a bit mixed. On some basic absolute metrics, it's apparently valued slightly higher than the overall S&P 500 right now.
Interesting. Higher.
Yeah. If you look at relative valuation, metrics like price to sales or price to book look strong compared to the market, which kind of reflects those reliable sales and solid balance sheets.
But the profitability metrics.
Exactly. Price to earnings, price to EBITDA, those look weaker relative to the S&P 500, reflecting the lower margins and weaker growth outlook we talked about.
And technically. Are the charts saying buy, sell, hold?
The technical analysis mentioned in the sources isn't really flashing a strong buy signal for the sector overall right now.
Okay, so let's try to summarize the investment case based on the sources. You've got the pros: consistent demand, stable earnings, reliable dividends, proven defense in recessions, low volatility.
Right, low missed sales expectations.
But then the cons.
Hmm.
That slow projected earnings growth, limited upside when the market's roaring, those price wars hitting margins, and maybe opportunity cost money could be growing faster elsewhere.
That sums it up well. And weighing those pros and cons, the overall recommendation coming from the source material seems to be hold.
Hold, meaning recognize the defensive benefits, especially if you're worried about the economy, but also acknowledge the headwinds like margin pressure and slow growth, not necessarily the place for aggressive growth right now.
Precisely. It's seen as a stabilizer, but maybe not an engine for major gains in the current environment.
You mentioned some big names earlier: Walmart, P&G, Costco, Coke, Pepsi. How do people typically invest? Individual stocks, ETFs.
Both are common. You can buy shares in those individual giants. Or, for diversification within the sector, there are exchange-traded funds, ETFs. XLP is a big one for U.S. consumer staples.
XLP, what's notable about it?
Well, it has a low beta, around 0.57 was mentioned. That means it's historically been much less volatile than the overall market, which fits the defensive theme. And it has a low expense ratio, which is good. There are others too, like KXI for global exposure or VDC.
Now, I did see some discussion, maybe in the commentary around the sources, raising a flag about some key holdings in those ETFs, like Costco and Walmart. The concern was they might be looking a bit pricey right now.
Yeah, that's a really important point that came up. Even if the sector is defensive, individual stocks within it can still become overvalued. If you buy a stable company at too high a price, you could still lose money, even if the business itself holds up well.
So sector defensiveness doesn't automatically make every stock in it a good buy at any price.
Exactly. It's a reminder that you need both sector analysis and company-specific valuation work.
Crucial distinction. Okay, let's pivot to the other major defensive pillar we're looking at: healthcare. This one also feels intuitively defensive. People get sick regardless of the economy.
That intuition is spot on. It's the core reason for healthcare's resilience, and it's a massive, diverse sector.
Right, much more than just hospitals and drug companies.
Oh, yeah. You've got the facilities, hospitals, clinics, then the drug developers, big pharma and smaller biotech firms. You have companies making medical equipment, everything from MRI machines to bandages. Then there's health insurance providers and those PBMs, the pharmacy benefit managers.
The ones who handle drug benefits.
Right. And now, increasingly, you have telehealth and digital health companies playing a big role, too. But the common thread, they all address essential medical needs. For most people, needed care isn't really optional.
And has this non-discretionary nature shown up in past economic downturns? How has the sector performed?
Very strongly, historically. The 2008 financial crisis is a key example. It was a brutal recession, right?
Absolutely.
The S&P 500 tanked. Healthcare stocks also went down, but much less than the overall market. It significantly outperformed. Why? Because people still needed treatments, doctor visits, medications, even when the financial system was melting down.
Demand held up.
It did. And even during the unique COVID-19 situation in 2020, while some parts of healthcare slowed down elective procedures, other parts testing, vaccine development, treatments, saw demand absolutely surge. It showed the sector's adaptability, especially in a health crisis.
There's some really striking long-term data mentioned, too, about overall healthcare spending in the U.S., something about it almost never going down.
Yeah, that National Healthcare Expenditures, NHE, data is pretty incredible. From 1960 to 2020, it grew way faster than the overall economy, like 8.7% annually, almost 3 times the pace of GDP growth. But here's the kicker for our discussion. In all the U.S. recessions, the periods of negative GDP growth going back decades, total NHE never declined. Not once.
Never declined. Even when the whole economy was shrinking, healthcare spending kept going up, or at least stayed flat.
Exactly. And even more than that, in 7 out of those 8 recessions between 1960 and 2020, NHE growth actually accelerated during the downturn. It spiked higher.
Why would that happen? Is it just pure necessity?
Yeah.
Or something else?
It's probably a few things. Necessity is huge, obviously. People prioritize health. But the structure of the system matters too. Widespread health insurance, both private and government like Medicare and Medicaid, means a lot of spending isn't directly tied to someone's immediate income or job status.
It buffers the impacts.
Somewhat, yeah. Plus, you have demographic trends, like an aging population, that create a steady underlying increase in demand for care, regardless of the economic cycle.
And looking closer at the Great Recession period, around 2007-2013, did the company's financials hold up, even if the stock prices dipped?
That's a key insight from the sources. While the stocks took an initial hit with the market, the actual business performance revenues, profitability like EBITDA for many healthcare companies, didn't really see negative growth or stay down for more than a year during that whole tough period. The underlying businesses proved remarkably robust.
Now, I remember seeing something about digital health investment bouncing back quickly then.
Yeah, that was interesting. Investment in digital health dropped in 08-09, like most venture capital, but it recovered almost completely by 2010, way faster than the overall VC market. It suggests that even in a crisis, people saw the underlying need and potential for tech solutions in healthcare.
Okay, the history and the essential nature make a strong case for resilience. But should we call healthcare stocks recession-proof? Is that going too far?
Yeah, I think recession-proof is too strong for any investment. It's crucial to be realistic. There's always market risk, and healthcare has its own specific risks.
Like what? What can still hurt healthcare stocks in a downturn?
Well, big regulatory changes are always a factor. Think shifts in how Medicare pays hospitals, or new laws impacting drug prices. Delays in getting new drugs approved can hit biotech hard.
Yeah.
Major healthcare policy overhauls, like the ACA debate showed, create uncertainty. And crucially, not all healthcare companies are created equal in terms of resilience.
Right, a small biotech firm trying to get its first drug approved is way different from a giant insurance company.
Totally different risk profiles. It helps to break the sector down.
Okay, let's do that. What about hospitals and clinics?
Healthcare facilities, yeah. Demand for their core services is pretty steady. Accidents happen, people need surgery, but their profitability can be really sensitive to policy changes, especially reimbursement rates from Medicare, Medicaid, and big insurers.
And the innovative end, biotech and pharma.
Huge potential upside, obviously, with new drug discoveries, but also significant risks. The long, costly, uncertain path to drug approval, fierce competition, the possibility of clinical trial failures. In a recession, smaller biotechs might struggle to get funding, and maybe regulatory approvals could slow down, though the need for existing essential drugs stays high. Established pharma companies with diverse portfolios are generally more stable than speculative biotechs.
What about the companies making the tools and equipment?
Medical equipment makers, diagnostic machines, surgical instruments, hospital supplies. Demand here is usually pretty strong because providers need this stuff to function. Many have long-term contracts, which add stability. Maybe big purchases of brand new, expensive machines get delayed in a really bad recession, but the need for consumables and maintenance continues.
And the insurance side, health insurers and those PBMs.
Relatively stable. People want health insurance, especially when times are uncertain, to protect against huge medical bills. But again, their profits and business models are super sensitive to government regulation rules about coverage, drug pricing negotiations, benefit designs. Policy is huge for them.
Okay, and then there's the newer kid on the block, telehealth and digital health. How do they fit in during a recession?
This is a really interesting area, especially learning from past downturns. Telehealth offers virtual care, remote monitoring, often more convenient and potentially cheaper than going in person.
So demand might actually increase in a recession.
It could, yeah. When people are watching their wallets, more affordable or accessible options become attractive. And the Great Recession showed us some relevant trends. Rising medical debt, people skipping care due to cost, more mental health issues.
All things that digital health aims to address, potentially at lower cost.
Exactly. There's a clear need that economic hardship can amplify. However, there's a nuance. While demand for the services might hold up or grow, the investment climate for digital health companies has cooled off recently after the pandemic boom.
So the venture capital is flowing quite as freely.
Right. These companies are now under more pressure to prove their value, show clinical results, demonstrate ROI, not just grow at all costs. So the service demand might be resilient, but the company's stock performance could still be volatile depending on funding and profitability.
Need versus business viability. Got it. Looking at the healthcare industry overall, what strategic lessons emerged from past recessions?
Well, the main one is that while the core demand is incredibly resilient, the industry isn't static. Change is constant. Leaders need to be smart about costs in downturns, not just slash everything, but really evaluate what's essential, where demand is shifting, like towards outpatient or home care, and focus on unique strengths. Innovation needs to focus on patient needs, accessibility, affordability. Recessions often accelerate the push for things like price transparency and embracing technology platform thinking, using data, things like e-prescribing or better electronic records becomes even more important for efficiency when money is tight.
And policy, policy, policy.
Always, you have to stay on top of it. History shows big policy moves. Medicare Part D, the ACA, HI Tech significantly boosted growth and resilience. Since government payers like Medicare and Medicaid are such huge players, like 38% of total spending, future policies on cost control or access, like the Inflation Reduction Act's drug pricing measures, will continue to shape the entire sector.
So fundamental demand, resilience, but constantly evolving due to policy, tech, and patient expectations. What's the current investment vibe? What are people looking at for, say, 2025?
The sources mention continued M&A activity, so companies are still consolidating and looking for deals. Specific areas getting attention include home care, behavioral health, which is a huge growing need, things like medical spas, and life sciences services like contract research. It shows investors are targeting specific growth niches within the broader defensive sector.
Okay, so summarizing the value proposition for healthcare. Strong historical resilience. Demand is non-negotiable because it's about health.
Right. That makes it a really powerful defensive component for portfolio, helps buffer downturns. But it's complex, heavily influenced by policy and tech. Not risk-free, especially certain subsectors, but that fundamental need provides a solid floor.
Okay, we've looked closely at consumer staples and healthcare individually. Let's pull it together now. What are the core similarities that make them both defensive plays?
The biggest overlap is that core business model, providing essential goods and services, things people need for daily life or health. That translates into relatively consistent demand, regardless of the wider economy.
Which leads to more stable revenues and earnings compared to cyclicals.
Exactly. That stability is why they historically tend to hold up better in recessions, cushioning portfolio losses. They both offer that sense of ballast when things get rough.
And often, stable cash flows mean stable dividends, too, which is another shared plus for defensive investors.
Definitely. Consistent dividend income is a hallmark for many companies in both sectors.
But despite those shared strengths, they're obviously different. What are the key distinctions investors should keep in mind?
Well, consumer staples is about those foundational daily needs: food, soap, paper towels. Resilience comes from that constant, basic consumption. But the big challenge is that intense competition and resulting pressure on profit margins. It leads to slower growth forecasts. It's reliable, but maybe less dynamic.
More of a grind, operationally speaking.
Kind of, yeah. Focused on efficiency and scale. Healthcare, though, addresses critical medical needs, maybe feels even more essential. Its resilience is profound, but it's much more tangled up with external forces like government policy, complex regulations, and really rapid technological change in areas like biotech or digital health.
So more complex, maybe. More influenced by outside factors.
Arguably, yes. It has pockets of high growth and innovation, but also carries specific risks tied to drug approvals, policy shifts that can dramatically alter the landscape, and the high cost of R&D. So resilient, but maybe more moving parts than staples.
Okay, one is steady daily consumption facing margin heat. The other is critical needs heavily shaped by policy and tech. Given these defensive traits, should investors just load up on these two?
And that leads us right to the crucial takeaway. Diversification. Yes, they're both valuable defensive tools with strong track records, but
no single sector or even two sectors is a magic bullet.
exactly. Relying only on staples in healthcare still leaves you exposed to their specific risks, margin squeeze in one, a big regulatory change hitting the other. Neither is guaranteed to be totally immune.
So the real lesson isn't just that they're defensive, but how you use them.
Precisely. It's about careful stock selection within these sectors, finding the well-run companies at reasonable valuations, and most importantly, using them as part of a much broader, diversified strategy. That's how you build true portfolio resilience.
Don't put all your defensive eggs in just these two baskets. They're ingredients, not the whole recipe.
Well put. And remember, there are other defensive options too. Utilities often fit the bill. High-quality bonds, maybe certain types of REITs owning essential properties like cell towers or medical buildings. Real diversification looks across asset classes too.
Right. Okay, that's a comprehensive look. Let's try to crystallize the main takeaways for everyone listening.
Okay, three key things to remember. First, consumer staples. These stocks offer that bedrock stability. It comes from the relentless demand for everyday essentials. That translates to steadier sales and earnings, acting as a cushion in downturns. But be aware of the current challenges, margin pressure from competition, and slower growth forecasts.
Second takeaway, healthcare. It has a compelling history of resilience, grounded in the absolute necessity of medical care. It's proven robust even in severe recessions, with spending holding up remarkably well. However, it's a complex sector navigating specific risks like policy changes and drug development hurdles, while also being shaped by innovation like digital health.
And third, bringing it together. Investing strategically in defensive sectors like these can add valuable stability during uncertain times. You're tapping into their built-in demand and historical resilience.
But they aren't foolproof. They have their own risks, their own dynamics. The smart approach is using them as key components within a larger, well-diversified portfolio to build overall resilience.
Exactly. So, thinking about everything we've discussed, the steady need for basics, the critical demand for healthcare, the influence of policy and tech, and how essential itself might be evolving. Here's something to mull over.
Okay, leave us with a final thought.
As you think about building resilience, how might you strategically incorporate investments that tap into not just traditional necessities, but evolving ones? Think about things like accessible digital health for our aging population, or services addressing critical needs like mental health care. How can you position your portfolio to be resilient for the essentials of today and tomorrow, whatever the future economy holds?